I am Xavier Vives from IESE, and I lead the banking initiative that with IESE and CEPR has produced this report on technology and finance, which is a part of a series of reports. Today, we'll have Darrell, Duffie, and Thierry Foucault, who are two of the co-authors of the report, and Tara Rice also, which will comment on several issues related to the report. Let me just remind you of some of the previous reports. So for those of you that have not followed the series, this started in 2018-19. We had the first report on, the title was Sound at Last, Assessing a Decade of Financial Regulation, so taking a stock basically 10 years after Lehman Brothers. In this case, we wanted to see what had been done to prevent future crises and whether this was enough. Let me summarize our response. The response to the question was that a lot had been done in terms of capital and liquidity regulation, but that there were areas of shadow banking where challenges remained, and I think we've proved right. Then we had a second report on the bank business model in the post-COVID-19 world. There we examined the threats to the banking industry, low rates, heavy compliance, and digital disruption in the post-COVID world. It concluded that in this case, banking had not been the problem, but that COVID would act as an accelerator of digitalization, and also that would maintain low rates for longer. And the result would be a deep restructuring of the sector where incumbents had to compete with, embrace with platforms to deliver financial services. Next, the previous report was on the resiliency of the financial system to natural disasters. This report wanted to test how resilient is the financial system to those disasters. COVID had been a warning, if you want, and discussed what could be done to make it more resilient. No? It discussed how to reshape central bank policies to address climate-related risks, debated the role of asset managers in dealing with natural disasters and climate risk, and explained why mitigation is a form of self-insurance to limit the systemic risks of global warming. Okay, and now it comes to this year's report, Technology and Finance, which, as I said, with Darrell and Thierry, and then Laura Welcome today cannot be with us. This report takes as a basis that information technology and the technological developments are disrupting finance, as we know, and we want to discuss how the impact of digital technology is in finance, both in markets and intermediation. What are the benefits and costs? What are the bright and the dark sides of this impact? And then, if policy intervention is needed, what kind? More in particular, the report has three main chapters: one about new payment systems, another one about data in financial systems, and another one relating to trading. The first one on new payment systems, that's what Darrell is going to talk about, concentrates on digital currencies, whether this is efficient, whether they are out of control, and in particular, it concentrates on the pros and cons of the central bank digital currency, which is something which many central banks are debating right now. The second is on data and data use, in particular in financial markets, what in the economy in general. What are the benefits? What are the risks? What are the trade-offs? And in particular, how to measure the value of data, which is something which is somewhat underdeveloped. Finally, on trading, and that's what Thierry will concentrate on, it looks at the electronification of securities trading and its effect on trading costs and market quality. In general, it looks at algorithmic trading, high-frequency trading, impacts on liquidity and fragility, whether one thing comes at the cost of the other. It looks at platform competition, whether they have too much market power. And just before giving the floor to our speakers, so let me just tell you very, very briefly some of the broad messages that come out of the report. In the first, the chapter on payment systems, we think that it is possible and desirable to develop more efficient payment systems, which can be based on bank deposits. So there is much room for improvement in different jurisdictions. There are different instances of different efficiencies, if you want, that can be attained, but that's a general statement which is true. Competition in payment systems should be fostered, and then the development of the central bank digital technology should be there. We should develop it, but this should be targeted primarily to overcome market failures and should not be rushed. And Darrell will be much more specific about that. On the chapter on data measurement and data evaluation, which we will not talk about it today here, we see how the increasing use of consumer data allows for efficiency gains, but also involves trade-offs. So this is not just goes in one direction. The trade-offs are in terms of privacy, efficiency, for example, with economies of scale, competition in relation to market power, or income inequality issues. To address the trade-offs, it is claimed that we need to develop appropriate ways to measure the value of data, and then several approaches are discussed, cost approaches, revenue approaches, reveal preference to measure the value of data, both from the private and social point of view. Finally, in the chapter on trading, what we find is that the electronification of securities trading and its effects on costs, trading costs, market quality, raise quite a few policy issues. Among them, we highlight 4 policy issues which are raised. One is that the market gets more fragmented, and the customers, the investors, need basically quick access to market data and a transparent view of the market across trading venues. So basically, for example, in Europe, we need a consolidated tape, something that we do not have. Then we discuss also, and we find trade-offs between the latency arbitrage due to high-frequency trading and the liquidity benefits. We find also that regulating dark trading may not be enough if the internalization methods are not controlled. And finally, we find that we need to coordinate circuit breakers mechanism as safeguards to prevent flash crashes. Okay, so with no more to say, I give the floor to Darrell and then to Thierry and Tara, which in sequence will talk about the chapters for about 10 minutes or so that we have time for debate, and then Tara with her comments. Darrell.
Thanks, Xavier.
Let's hope it works now.
I've got lots to say in only 10 minutes, so let me jump in. Thanks very much to CEPR for letting me have a chance to speak here today. As most of you know, we're at a crossroads in the policy debate over what to do about digital currencies. And I want to give you a kind of bird's eye view of that from the viewpoint of our report. I'm going to start the story with, if you read the payments technology literature, it's always Alice and Bob. Here are Alice and Bob. Alice is at the bakery. She needs to buy a loaf of bread from Bob the baker, and she needs to pay him $8. And all this debate about is, how is she going to do that? What is the most effective way to do that? And in the vast majority of dollars that are moved, or euros, the technology is bank railed. What does that mean? It means Alice sends a message to her bank, could be a credit card tap or a paper check or a wire transfer or direct transfer. The message is to tell her bank, take $8 out of my account, credit Bob's account at his bank for $8. It's pretty simple. And Bob sees a message saying the money will get there eventually, maybe, and give Alice the bread. By the way, this idea for making payments goes back to Loriana's home city, Venice, in around 1605. A technology developed by Banco del Giro, which is the same Giro as the Giro d'Italia, which means the money circulates through the banking system by a sequence of debits and credits to various accounts, rather than taking an asset and moving the asset, which is what many people think is actually happening. No, Banco del Giro had the right idea for at least 300 years or 400 years, and now people are talking about changing that. The next technology that people have in mind is a central bank digital currency. So the idea here is that there's one place where the debits and credits occur. That's the central bank. Alice sends a message through a payment service provider, which could be her bank, telling the central bank, take $8 out of Alice's account and put the $8 into Bob's account. It's very simple. There's only one bank involved as far as assets and liabilities. This is the model that's going to be adopted probably in the Eurozone. I was at the ECB last week. I talked to Eveline Witcox, who's running the Digital Euro project. Next year, they'll make a decision to do this. Probably, I'm guessing yes. And then within 3 years, supposedly, they're going to have this system up and running. That's a very aggressive schedule. And why are we doing this? A governor of the US Federal Reserve says that this is a solution in search of a problem, that there is nothing wrong with this system that needs to be cured. Mervyn King, the former governor of the Bank of England, just chaired a report at the House of Lords with the same title, A Solution in Search of a Problem. Is that the case? So here's my policy perspective on this. This old bank railed system is capable of doing almost everything that this system can do, but it's not doing it. And the whole problem goes back to what we discussed in the last session. It's a lack of competition. So let me walk through the competitive issues here. These banks are not being forced to compete with each other because they are essentially in a protected guild. It's not the number of banks or concentration in the sense of Herfindahl index that's the issue here. It's the fact that each bank puts high switching costs on its customers, and also its customers have very high attention costs, and so they're quite lazy about moving from one bank to another, and therefore these banks don't face much competition. And to fix the problem, we could introduce a central bank digital currency, because that would cause banks to compete harder, in this case against payment services with the central bank, or we could do other things. What are the other things? One is to introduce cryptocurrencies like stablecoins into the general payment system, which is probably the next thing that's going to happen in practice in most countries. These stablecoins, as you know from a couple of weeks ago, can be very unstable in practice. However, nothing prevents them from being made to be stable by regulation. And that's what the United States government is considering doing. A President's Working Group report says, make these stable by forcing them to be issued only by regulated banks or regulated depository insurance institutions. Now, you may ask, if they're only allowed to be issued by banks, how does that increase competition for banks? Well, maybe there could be new kinds of banks that are issuing these, and maybe that could create the kind of competition that's needed. So far, we don't know. It's a wide open space, not only in the US, but almost everywhere internationally, what to do about regulating stablecoins or other cryptocurrencies so that they can be A, useful in the payment system, and B, not a problem for financial stability, investor protection, money laundering, and many other problems. I'm going to spend more of my remaining few minutes on fast payment systems, because I think in terms of things that can be done within 5 years that are effective, fast payment systems are the way to go. This, by definition, means Bob gets his money 24/7, 365, instantly, no counterparty risk, and it's real-time gross settlements. It's the same kind of payment system that banks have already. It's being introduced in many countries. I want to focus, as you can see from this list, the United States is introducing it, but in the United States, under the real-time payment system, RTP, or the new one coming in from the Fed, called FedNow, the fast payment system will be provided to banks so that the banks can then choose how they will provide fast payment services to their customers. Now, if I was the head of the Bank of America or JP Morgan or Barclays, I would not say, you know what, we should provide fast payment services directly to all of our customers and disintermediate all of our credit cards and other profitable franchises. So I don't expect fast payment systems to be provided in a highly competitive, interoperable way unless that's forced by regulation. Brazil did that. Brazil has this fast payment system called Pix, in which Alice pays Bob instantly through a centralized hub, which is a single interoperable payment application interface. Everybody has the same thing on their mobile phone. Adoption in Brazil went from 0 to 105 million adults in the first year, and now essentially every adult in Brazil, according to Roberto Campos Neto, who I met about this 2 weeks ago, says this is now the go-to payment system for the retail market in Brazil. If you look at the adoption rate in Brazil versus the other countries that have adopted fast payment systems, you can see that the color for Brazil, in terms of transactions that are conducted per capita, shoots up immediately. Why? It's because of the high degree of interoperability. Everybody using the same hub. The banks cannot put walled gardens around their payment services. The walls come down. Everybody interoperates with everybody else. I'm simplifying for sake of speed. The vertical bars here are the merchant costs, which are charged in a market for payment services to merchants. The merchants themselves pay almost nothing, $0.0005 per payment, but there's a free market for payment services, which turns out, as you can see on the right-hand side, the equilibrium is that merchants pay a much lower fee than they would if using a credit card or debit card. The reason that Europe has such low credit card fees is that they're regulated low in Europe. In the United States, they're not regulated, they're very high, and that makes for two-sided market problems that were discussed in the last session. What about competition for deposits? If you introduce almost any of these, a stablecoin, a central bank digital currency, or an interoperable fast payment system, the cost for bank funding is going to go way up. The left-hand bar is the wholesale cost for funding for banks. Going back to the last time at which central bank policy had elevated rates to a non-trivial level, which was April 2019. The red bars on the right are what retail depositors and transaction deposits at the wholesale level received at U.S. banks. And this is weighted average across the whole banking system. As you notice, depositors are getting a terrible deal at U.S. banks, and the reason is competition is way too low. If you introduce any of these methods, CBDC, stablecoins, fast payment systems that are highly interoperable, those red bars will all go up, and the cost for banks of obtaining funding, which is about 2/3 of the funding of U.S. banks, will shoot way up, and that raises a problem for central bankers. Central bankers are very concerned about disrupting banks by causing their cost of funding to go way up. What would that do to bank credit provision? Because if you raise the cost of inputs, seemingly the cost of outputs goes up. Well, not so fast. Unfortunately, I don't have time to give you all of the economics of this. Here's a quote from the Fed. I'm going to have to turn around to read it. A widely available CBDC would reduce the aggregate amount of deposits in the banking system, which could in turn increase bank funding expenses and reduce credit availability. And there's a similar quote from the G7 banks and BIS. Is this actually the case? The best available modeling says no, it's not the case. And the reason is that the largest banks, which are offering most of the deposit services, are also obtaining their marginal funding on wholesale markets, and they're providing wholesale funding to other market participants. And when you raise an inframarginal source of input, that is deposit funding, raise that cost, it doesn't affect the marginal decision to fund on the lending side. I have a couple of charts about that. I'm not going to have time to go through them, but do I have a minute?
You have a minute.
Okay, well, let me jump ahead anyway. I'm going to skip through all that, and I'm going to go directly to policy conclusions. So first, yes, invest in CBDC technology because it may offer technology of the future for smart contracting, programmable money, many other applications that are way out on the calendar, coming later, and they may provide the needed competition if none of the other methods that I've suggested work. So get busy because it takes years to develop these technologies. And if you start only when you realize you're going to need a CBDC, then you're going to have to wait another 5 or 10 years. So get busy right now. That's my advice to the US government, at least. But at the same time, create competition for bank payment rail payments, bank rail payments, by allowing compliant entrants, whether stablecoin providers, fintech neobanks, or banks themselves competing against each other because the market structure is changed by an interoperable fast payment system. Of course, there are specialty applications for CBDCs, which we won't discuss today, and there's a whole regime of international implications for changing digital currency structures, including what is the impact of dollar dominance, what is the impact on the ability to impose sanctions, what is the impact on monetary sovereignty of emerging market and open economies that will have to compete against a kind of raging dollar on steroids that's available anywhere in the world on your Apple or Android device. So to be continued. Thanks very much, Thierry.
Thank you very much, Thierry.
Okay, thanks. I'm going to talk about the part of the report which is on the effect of new technologies on financial markets and trading in those markets. And so securities markets in many ways can be viewed as a technology to share risk and discover asset values, to aggregate information to discover asset values. And this technology does not fall from the sky. It is provided by for-profit companies, which increasingly look like a fintech. Those companies are, for instance, the Intercontinental Exchange in the US, which is a big operator. It is the owner of the New York Stock Exchange, Euronext in France, or Deutsche Börse, or the LSE in England, for instance. And so they increasingly look like fintech in the following sense. They use algorithms to match buyers and sellers on their platform. Doing that, they generate a massive amount of data, and they monetize the data. Increasingly, they get their revenues not from the matching part, but from the sale of market data, which is a very important change in the way they think about market design, the way they think about pricing of their activities. And they use innovative pricing schemes. They are very much like two-sided markets, for instance. There are many aspects of the competition between platforms that are reminiscent of what you see in other digital industries. So the goal of the report is to take stock of this evolution, ask what are the consequences of this evolution, and what are the policy issues that are raised by this evolution. So there are 4 consequences that are highlighted in the report of this evolution. The first one is increased market fragmentation. The cost of launching a new platform has decreased a lot, and not surprisingly, that generated entry of competitors for the incumbent exchanges that has been encouraged by regulation, both in the US and in the EU. And as a consequence, there is much more dispersion of trading across different platforms that compete together for the order flow, for the sale of data. That's the first consequence. The second one is the emergence of algorithmic trading, the automation of the order submission process by institutional investors to place their orders, and the emergence of a particular type of algorithmic trading that consists in using computers to react super fast to information. That's the so-called high-frequency trading. A third consequence is a new business model for exchanges. I already mentioned that before, which is increasingly exchanges are trying to get revenues from market data. They face a lot of competition on the sale of trading services. As I'm going to argue, they are more like local monopoly for their own data, so they try to generate revenues from that activity. And there is a fourth consequence that I'm not going to discuss today for the sake of time, but that we discuss in the report, which is electronification is changing very fast the way trading is done in over-the-counter market. Bond markets, treasury markets, markets that used to be bilateral are becoming more and more multilateral with electronic trading. So let me come back on each of those consequences and the policy issues that they raise. So the first one is market fragmentation. So here, this is just a very stylized representation of the market structure for equity trading, both in the US and in Europe. It's very complex. The market for equity trading is very complex, both in the EU and in the US. It has essentially two layers. There is one layer which is called the lead trading segment, where you have platforms which are relatively transparent, limit order book markets, where quotes which are posted in the market are displayed in real time. This is the sense in which they are transparent, that compete together. For instance, Euronext, which is the primary market for French stocks, is facing a lot of competition for other markets like CBOE, for instance. So the primary market in Europe typically has about a 60% market share of total trading volume. So you have fragmentation in this dimension, and then you have another dimension, which is you have another segment where people trade a lot, and increasingly so, which is the dark segment. And the dark segment is made of two sub-segments. You have dark pools, which are just platforms that match buy and sell orders without providing information. That's the reason why this segment is called dark pools. And then on the side, you have another segment, which is internalization. And internalization, that's a practice that's just market making. Market making taking place out of the exchange, out of the lit market. That's just an OTC market in a sense, in parallel to the main market. And the market share of this segment is growing and quite high. It is between 40 and 50% of total trading volume in equity in Europe. And this is raising question because the migration of trading to the dark segment may generate a negative externality for the lit segment. It may lead to larger trading costs and less price discovery. So regulators in the EU have taken, this is the case both in the US and in Europe, and in Europe, regulators have taken steps to try to mitigate this evolution by capping the amount of trading in dark pools. What the report argues is that that's one step, but that might be insufficient. Because in fact, the vast majority of trading is not in dark pools, but it is internalized. And internalization trades which are internalized in Europe, for instance, they are more transparent than trades which take place in dark pools, but they are not fully transparent as well. You have many ways, to escape transparency with internalization. So the first point, the first policy recommendation here is that might be a good idea to cap trading in dark pools. It's true that there might be a negative externality here if there is too much trading in this segment, but then, all type of trading that is in the dark segment should be capped in some way. At least, regulators should pay much more attention to internalization, I think. So the second consequence is algorithmic and high-frequency trading. So when the market, given that the market is electronic, is a computer, it makes a lot of sense to use computers to interact with the market. So it's not very surprising to see, a growth of algorithmic trading, but there are really two types of algorithmic trading. You have institutional investors, asset managers using algorithms to slice large orders to mitigate price impact and reduce their trading costs. That's good. That's good for asset managers, and that's good for investors in mutual funds, for instance, that are going to make cost lower. On the other hand, you have prop trading firms which specialize in using computers and algorithms to access to information very fast and develop trading strategies based on fast access to information. Those strategies are the usual ones, which is market making, arbitrage, and speculation on short-term directional trading, which is anticipation of where the price is going to go in the short term. Is this bad? Well, there are many controversies about high-frequency trading. There is this book which was published a few years ago that attracted a lot of attention that say that the US stock market is rigged by insiders being the fast guys. Well, that's probably too extreme, and what the academic literature suggests is a much more nuanced view. And the overall effect of high-frequency traders on the market seems to be positive. There are many studies that show that overall, at least there is a positive correlation between the amount of high-frequency trading and liquidity and price discovery. But the important word here is overall. That's the aggregate effect. And in fact, when you look in details, there are many different types of trading strategies. And increasingly, what the literature does is to zoom on one particular type and try to analyze what is the effect of a particular type of strategy. And one strategy which may not be so good, which may have a bad effect, is latency arbitrage. Latency arbitrage consists in reacting very fast to information, news, for instance, macroeconomic news, to take position based on this information. And because people act a split second before the people in the market, the profit they are going to make is potentially at the expense of their counterparties. So that's not good. That's asymmetric information that generates adverse selection. Adverse selection is bad for liquidity. There are several papers that show that this effect is there. Is this a big effect? That's the second point of the report. That's very unclear. There is a lot of attention, on those guys, whether they generate, cost, adverse selection cost. There is no doubt on that. Whether the negative externality is that big, that's much less clear. So here, the recommendation in the report is to be careful, because there is a risk, of latency arbitrage come in many ways, and there is a risk of killing the patient with the cure here. So one has to be careful in the way, to regulate latency arbitrage. So third concern is algorithmic trading may be a source of fragility. There have been many occurrences of flash crashes in the last 10 years, starting with the 2010 equity flash crash. Then you had the Treasury flash crash, the ETF flash crash in 2015. And so people are thinking that maybe this has to do with algorithmic trading, because more or less that happened at the same time. Correlation is not causation. And there have been many reports on those crashes by regulators in the US. And I must say that the cause of those crashes is really not clear. And certainly what you get from those reports is that even though algorithmic traders may have played a role, they are not the ultimate cause. So what we argue in the report is that maybe the reason why those events are more frequent is due to a combination of factors, which is many platforms are electronic limit order markets. And those markets, to work, they need a balance between the flow of people consuming liquidity and the flow of people providing liquidity. Those flows need to be balanced. If, for whatever reason, at some point in time, the demand of liquidity jumps, there is a good chance that liquidity providers will not be able to react fast enough to match, this excess demand. And so that can generate very, very large price movements. So maybe one has to think about ways to better coordinate liquidity supply and demand. Another reason why we may see those events more frequently is that due to regulation after the financial crisis, it's more difficult for banks to make markets. And in a sense, market making by banks has been replaced by market making by fast traders, by high-frequency market makers. But those market makers are more likely capitalized than banks. So their risk-bearing capacity is smaller. So that's another source of fragility, which may explain why suddenly liquidity evaporates sometimes. And then the third reason is that markets are better linked together due to electronification. So that means that when there is a shock in one segment of the market, this shock is going to propagate much more quickly than in the past to other segments. That's good. On the one hand, that makes markets more integrated. That's good for price discovery, efficiency. On the other hand, that means that when the shock is non-fundamental, you are going to transmit non-fundamental shocks much more quickly to other parts of the system. Last consequence, it's a new business model for exchanges. So revenues from market data for exchanges are increasing. You have some numbers here. And not surprisingly, investors are complaining. Institutional investors in a fragmented market environment, they cannot place their orders optimally if they don't have a good view of the liquidity available in the different segments, in the different platforms. So they need to buy the data. So in a sense, you have a captive demand for the data. And on the other side, the data from different platforms are not perfect substitutes. That is, if you really want to trade in two different platforms at the same time, you really need to see the limit order books of the two platforms at the same time. So that gives some local market power to trading platforms. That might be the reason why people perceive the cost of data as being too high. So I think there is a ground, for concern here that may justify regulatory intervention in this space. But I think that one needs to think about two things here, which is we don't know what is the cost. We don't know well what is the cost of producing those data by exchanges. So it's difficult to say whether the price of the data is too high without knowing what is the cost. So the first recommendation is that exchanges should provide much more information on the cost they bear to produce and disseminate the data. That's the only way to check whether their margins are too large, and there is very little information on that. Second thing is that regulators should be wary of an unintended effect. Trading fees are very, very small. Sometimes they are even negative on some platforms. So that suggests there is cross-subsidization from other activities. And it's likely that this other activity is the sale of market data. So if you cap revenues from the prices from market data, there is a good chance that trading fees are going to increase. And I think that institutional investors who are pushing for a cut in the price of market data should be aware, of this transfer. Last thing, in Europe, there is no consolidated tape, in contrast to the US. That means it's people who trade, institutional investors who trade in Europe, they need to aggregate by themselves the data from different platforms. That's costly. So it is urgent that regulators push for a consolidated tape, both in equity markets and in bond markets. That's on the regulatory agenda, but my understanding is that we are not yet there. And so to conclude, the electronification of trading in securities market has improved liquidity and price efficiency. There are many studies that show this. But there are some issues which have to do with competition policy, IO, the level of transparency that we want in the market, the role of algorithm in market, and that's specific to financial markets, but not only, and intermediaries' risk-bearing capacity. Thanks a lot.
Thank you very much. We'll have Tara. You have a slide, right? Which are these ones?
Voila.
Okay.
Super. Thanks.
Here you are.
Well, thanks very much for the invitation to discuss the report. It's a very timely report, I have to say, especially given recent developments with Terra and Luna, really at the cutting edge. So I really enjoyed reading the report. I'm going to focus my comments today on the payment section because that's most closely related to our work in the Committee on Payments and Financial Market Infrastructures. And let me just note at the outset that I think Darrell's 5 policy recommendations are spot on. So use regulation and faster payment systems, allow entry of stablecoins subject to standards, CBDC, launch when gaps are closed, support wholesale CBDC, and analyze dollar dominance. So I'm going to talk about fast payment systems and CBDCs. I'm going to link this to some work that CPMI is doing because it's coming out just before the G20. You beat us to press by a month.
I'll take notes.
So the first one I want to talk about is the G20 report on interlinking of payment systems and the role of APIs. Really very, very important faster payment system developments, as Darrell highlighted with that map. We've got some similar work showing also that there is just this proliferation of faster payment systems throughout the world. And with that, and also let me just note, there's also been developments to renew RTGS systems. So both of these developments together mean that as the technology is improving, we have opportunities for interlinking. So far, interlinking arrangements tend to be very regional in nature. What we need to do is sort of figure out how to expand that to be more, rather than bilateral links or regional links, really more global. There's a lot of benefits to interlinking: settlement efficiency, cost reduction, more competition, as Darrell was highlighting, shorter transaction chains. There's a number of challenges too: limited political support, startup costs, of course, and one of the most important challenges is divergent legal, regulatory, and oversight frameworks. There's a lot of work going on in this space, but this is a very, very difficult problem to solve. I'll skip over that. Okay, so just one other point on that interlinking report that's coming out. It provides a framework for thinking about how jurisdictions would want to take forward work on interlinking. It outlines a set of factors and components. They're here in this triangle that jurisdictions should consider. So it doesn't tell jurisdictions to do this or that, but rather provide some guidance and some practical sort of considerations. Related to this is APIs, and PIX is very, right? PIX is successful in part because of the development of APIs. APIs are open source, they're simple to implement, they're less restrictive, and they're well tested in the payment space. The one issue that we have, though, is that while we know the benefits of APIs, what we don't have so far is a small set of harmonized APIs. So what this means is that developers are creating APIs for just bilateral links. then what that means is if you want to add other jurisdictions to it, you need to come up with another API. So we're doing work right now on, well, first we started with a survey that asked payment system operators about their adoption of APIs. So 85% of those operators will use or plan to use APIs. And 90% of surveyed payment system operators see APIs as helping to overcome a number of frictions in cross-border payments. As I said, lack of standardization is seen as a great challenge. So the next component of this work, which I really think is going to take forward some of Darrell's suggestions, is the BIS Innovation Hub in the next step of the project is going to actually build some proof of concept API. So we'll launch a proposal, sort of like a tech sprint, and then we will pick a couple, or the hub will pick a couple to implement. There's some excellent case studies out there. India and Singapore are going to link their FPS systems in the second half of this year. And so we've got some case studies. As more and more come on board, I think this is going to serve some valuable lessons. CBDCs, I would agree. It's a problem or a solution without a problem. So we have done a number of work on CBDC involvement in CBDCs, central bank involvement in CBDCs. Our 5th survey came out just this month. What's interesting is that now about 80% of central banks in some form or another would like to, are developing CBDCs. What's interesting here is that they're interested in retail and wholesale. Some are even doing both. Darrell in his chapter talked quite a lot about retail CBDCs, but let's not forget wholesale either. Wholesale CBDCs are nearly as equally likely in the foreseeable future. So that would get around some of these issues that Darrell had mentioned about, well, a lot of them, about disintermediation. There's less issues having to do with AML, CFT compliance if you're talking about a wholesale solution rather than the retail solution. And I think this chart is super interesting. It actually shows, this is a survey of advanced economy and emerging market central banks that responded to the survey. And what I want you to see here is that actually it looks to be that central banks think that wholesale CBDCs could potentially address more frictions or address frictions to a greater degree than retail CBDCs. This has been changing over time, but certainly those red dots, you can see that they're moving out to the right-hand side on the right chart. Cognizant of the time. So another G20 report coming out is for the second year in a row, BIS Innovation Hub, CPMI, World Bank, and IMF have gotten together to look at options for access to and interoperability of CBDCs. This is taking the work from the G20 report last year a step farther. Here, we analyze options for access to and interoperability of CBDCs that can improve cross-border payments. The approach taken in this report is to present access options for both wholesale and retail CBDC. Think about interoperability, which is a really, really big component of payments. And I'll talk just one more bit about that. And then it takes these options or principles that were in both the Group of Central Banks report and the G7 in terms of do no harm, efficiency, resiliency, coexistence, and interoperability with non-CBDC systems and financial inclusion. It looks at all of these criteria and then assesses like what kind of design features can help to achieve these quote-unquote criteria. And then finally it talks about the implementation challenges. So just a couple key conclusions. I won't go through all of these. One thing, so there are a lot of challenges with CBDCs. They are in development. But one of the positive benefits, one of the benefits of CBDCs is that it offers a clean slate. That means we can think about the design features as an international community ahead of time and see that we can get that interoperability that's so important. However, and I like this line, that clean slate feature has an expiration date. So we can talk about it for years, but at some point or another, the developments can be farther along, far enough along that we don't have a clean slate anymore. So for this reason, international standard setting bodies and organizations are really urging jurisdictions to work together and collaborate to make sure that we get some of those key design features in place, agree on them before taking development further. One size does not fit all. There's lots of different motivations for CBDC. In emerging market economies, tends to be more on financial inclusion. In advanced economies, a bit more on safety and efficiency of payments. Access and interoperability are seen as complements. So direct access, which is also talked about in the chapter, and the importance of that, because it does offer competition to non-bank payment providers. That's really important, but it's not enough. We need the access and the interoperability together. It's not a panacea. There are a number of central banks that are not pursuing it that actively. U.S., of course, is one. The one risk that was highlighted in the report is that there are a number of underserved corridors that will remain underserved corridors, and the needs not met. One interesting point here on interoperability is that we've got some related work on ISO 20022 adoption, which is another standard that's needed for interoperability. Currently, we just did a study, many central banks or jurisdictions have said that they will implement this message format standard, but only 40% have. So I've heard folks say, oh, we've got ISO we've got interoperability and harmonization taken care of because we've now got a message format standard that's harmonized. That's not true. Only 40% have implemented, and about 80%, 85% will. But importantly, a number of underserved corridors in Asia and Americas have said that they will not. So we're not getting to those countries that we really need to get to. And the last thing I just want to highlight is our standards. That would be Darrell's second point, which is to allow entry of stablecoins and other digital currencies, but we have to have standards. So CPMI, along with IOSCO for the last 2 years, has been working just on that, developing standards for stablecoin arrangements. Let me rephrase that, not developing standards, but applying our existing standards to stablecoin arrangements. So we've provided guidance to clarify how our PFMI, the Principles for Financial Market Infrastructures, could apply to stablecoin arrangements. The standards that we have are 180 pages, so this was not light work. What we did was we found that there's a number of notable features in stablecoin arrangements in terms of size, risk profile, interconnectedness, and substitutability that need to be thought about sort of differently. We provide clarity on 4 principles, and I think one of the most important is two of the most important are on settlement finality and money settlements. So historically we've had central bank money and commercial bank money. We consider those to be safe settlement assets. It's not clear, well, it is clear, a stablecoin is not a safe settlement asset. So how do we want to think about what can make stablecoins, a safe settlement asset? Finally, there is ongoing work on what we call responsibility E. It's cooperation with other authorities. That's going to be really important when we think about applying these standards internationally. What we don't want is to, of course, apply those standards differently across jurisdictions. We fear that would be reg arb and a race to the bottom. So that's quite important to us. Let me just close there. Let me add just one more point, just because I think it's interesting. So Darrell's point on banking and trying to increase competition is really, really important. It's not clear how we can do that. We've been thinking about it for decades, right? So we did a survey on opening hours, extending and aligning opening hours for payment systems. We offered 3 choices, 3 end states, and asked fintech, non-bank payment service providers, banks, et cetera, which end state they wanted. Just a little bit of an increase in operating hours, a medium-sized increase, or full 24/7. The banks said what? 1. They wanted very little change because it was too expensive. All the fintechs, they all went for 3. Like hardly anybody chose the middle option. So there was such a divergence between the banks and the fintech that I think this, getting to the competition problem is going to be hard. I'll close there.
Thank you very much.